So this, as we mentioned, we've done 2 already. This is part 3 on advanced tax strategies.
So we'll dive through that in a minute. To give you a small hint of what we did first, because this is a big presentation part, we talked about the Southern California Institute to understand Shelley and my bias. We have an educational institute that puts on over 200 programs a year on legal, financial, and tax planning, as well as counseling. As short as an hour, as long as 5 days, and in order to help the industries be able to attract and engage work with clients. Founders Group is our value acceleration firm. Been around for over 20 years, just like the Institute. We help business owners with the decision, do I keep and grow the business, or do I transition it to my family, to my employees who are like my family, or to a third party, in whole or in part, now or in the future. So we help prep businesses for the sale. Struzari Mancini, the firm that started it all 25 plus years ago with my partner, Steve Mancini. We help successful families and business owners, A, get to the heart of how the relevant matters, and B, resolve messes in 3 areas: integrated tax and estate planning, which is what we're talking about today, business succession, part of what we're talking about today, and family governance counseling, which we'll talk about in a couple more sessions, which is family business conflict. Shelley Lightfoot, her background, just with me, my partner at Founders Group, her background is in the financial services industry. Started out on a smaller broker dealer, went to Prudential, eventually Bank of America on the security side, became an OSJ, Series 24 as well. Came to San Diego to run the office with Paul Link on the security side, on compliance, and we stole her to the dark side. So now it works exclusively with us. She no longer hangs her license anywhere. She hangs out with us. Shelley is our Chief Operating Officer and helps advisory firms grow their practices. I'm Joe Struzari. I'm a tax attorney, and you'll hear a little bit more about me today. So you know our bias now. On the quick overview of the anatomy of choice that we went through in the prior 2 segments, if you haven't seen it, in the anatomy of choice, we talked about it's a stage before the 3 gates. If the 3 gates are that review and enhancement design, enhancement initiatives, and then a decision, should there be a step beforehand that's free to the client that has them go from, what are you talking about, to I need to hire you? So on there next, if you could show, it's that pre-engagement beforehand. The pre-engagement beforehand, what causes the client to come to you and causes the client to say yes to their triggering event.
And has them really partner with you to design their own engagement and move forward, I think is an important piece.
So we have a concept called the 5 limitations to progress. There's a book on it and some talking tools around it where you have conversation with the client on these 5 points that are not about EBITDA, not about final multiple, et cetera, but subjects that drive them according to 300 of our prior clients that we surveyed. Next, Shelley.
Speaking of surveys, if you would like to test that out, this is a quick 5 to 10 minute thing that you can go take and see what it's like. Just text that code EPI-5 to the text number that's listed there, enter your name and email address, and it will send you a link to take it. The goal here is for you to be able to see the results and the points of clarification and how it can drive a conversation with a business owner.
Next bit, Shell. Gonna go back for one more. Again, the anatomy of choice is about how do you get the client from not knowing what you do, or kind of knowing, and maybe interested to they must have you. This gives them from a 5-point conversation. They take this survey. You have this 5-point conversation again with the survey results of what's going on in their soul. What's going on in their soul that's behind it all, that's driving them. What are their drivers? So they've got a list of that, and you do. Even if they answered a couple of questions wrong that they could cross out, it gives you a starting point to get underneath it all to then drive a big engagement. The next slide is about the missing math. We talked about could you reduce the amount of due diligence hit? So by doing the value acceleration, can you make sure they get the full cost of the business, the full value of it, and then only get hit a little bit in due diligence, maybe just a little bit in cost of sale and less on the taxes, to be able to say, okay, I'm gonna get enough out of the business to survive me. We talked about we gave a case study on, okay, if I get X out of the business every year in salary, Joe, plus Y in benefits for Z. If I sell the business and I get hit, like I said, in due diligence, and I get hit in the cost of sale, and then I get a big hit in the taxes, I get a bucket of money. That bucket of money at 4, 6, or 8% produces what to me? And as you can see on this graph, mom and dad were getting $1.2 million a year. Each of the kids were getting $200,000 a year. At what point did it make sense to sell the business? So what level of return? But you had to solve for the taxes and had to solve for due diligence. So let's go, Shell.
All right. So
We're
one
going to
of
talk
the
about
ways
advanced
to
tax strategies.
Yeah.
This is going to be a fast-paced conversation. It's usually the personal and financial assessment that drives they're not financially ready. So we should talk about tax savings. It's one of their 5 transition goals. It's aligning the personal and business goals together to make that happen.
If you look at the EPI methodology, same thing, right? It's about assessing the personal and financial. And this is to identify, not that we're financial advisors, but we can identify the need through those assessments and identify it as a need. So
these are the top 70% of legal, financial, and tax strategies, that the law firm Snider Mancini used last year to help business owners reduce the cost of sale, in other words, reduce the taxes on sale, deal with income tax planning, deal with estate tax planning, deal with asset protection. So as our friend Simon Singer would say, it's about timing, combining, and sequencing. Timing, combining, and sequencing of these types of strategies listed under each financial planning goal. Some are listed more than once. Let's say the charitable strategies, because they can do more than one thing at the same time or do one or the other. So it's how do you time, combine, and sequence to make this happen. So we're going to talk about the 10 steps to partnering for engagement. So identify your fork in the road. All of us go through and we have the first meetings. You get on the map and the client finds you through a center of influence, et cetera. Then there's some sort of meeting with a client. There's an initial contact and your first visit where you're deciding what to do with them. They say yes, and the bottom area are the internal meetings and the top area, the client-facing meetings. Next slide, if you wouldn't mind, Shelley. The question often is, when you partner, how do you do that? When you partner, how do you do that? And it happens at the introductory visit. We are finding that you do the same process that you do now, but at the introductory visit, do you use your process or a partner's process? If we're doing tax planning, I'll use Snider Mancini. So to combine these, Shelley will show that it's one process really. It's you getting on the map, having that initial client meeting, the initial contact, and at the introductory visit, deciding to go up or down. At the introductory visit, to use your process or partner with somebody else that does this kind of work. Next, Shelley.
So it's about the tax planning, yes? Yes,
so timing, combining, and sequencing of those. So let's talk about a case study. We're going to compare two partners that sold the same business. We're going to have an introduction and overview, some case facts. We're going to discuss strategies that we consider for each one of them, the chronology of how they each grew into different plans and then somewhat together, and what we considered for diagrams side by side for each one of them. And then we'll quickly show you a design book that we'll flip through quickly to give you an idea how do you present those ideas to a client. So the two partners design.
Oh, I'm going backwards. I apologize. Oopsie.
I'll do whatever it is you tell me to do.
There you go.
So here's how it started. These two guys, Rick and Travis, founded Vessel Tech in 2009. Software company. They've got $12 million in EBITDA on a $60 million of sale. They were approached by a strategic buyer offering them $110 million to sell, which they didn't even think about it before, but 110 got their interest. The collaborative team started with a financial advisor at one of the major wirehouses, UPS, that was a SEPA. There was in-depth tax, financial, estate planning options reviewed, and the plans completed for the $110 million sale with that SEPA. That was the financial advisor, and a SEPA us, who happened to be an attorney, where we combined together. Then the During due diligence, the buyer dropped out for reasons that are unimportant other than they misread or didn't like what they did read on employment agreements and non-competes. So suddenly you went to a bidding war and they got offered $130 million. It was a CPA firm and a Nevada trust company who were also CPAs that were brought in, and then we adjusted the planning multiple times. So they need transition planning. They need income tax reduction, estate plan integration. They want asset protection. One of the partners wants charitable planning, and they both want to think about legacy planning, but one's more concerned about the kids and the other one's less. So as you can see in the Martin family assets, the big value of the company is their half. And they estimate it in the beginning now. Let's call it 120. Let's call it 120 divided by 2 is 60, Joe. They're out of their net worth. My gosh, there's a lot. But if they talk about long-term capital gains tax and an estate tax, it reduces it down to 43. Should we deal with the long-term capital gains tax? And should we deal with the estate tax? And should we deal with the balances? So yes, the Martin's goals are fairly direct, just like we did. They're concerned about their children more than the other client. They're worried about cash flow. And then the next client is the infant family, Travis and Chrissy. Travis and Chrissy have two more or less young adult children. They're a little less worried about their children's future. As you can see, again, big part of their estate is in this business. But they're staring at a lot of tax for it. What do they do about it? This one, by the way, is much more of a gunslinger. And you're going to find out he's going to go in opportunity zones and he's going to build his own properties with some of them. So similar ones. They do want to make tax-free gifts to the kids, less concerned about it. Next, please. Big focus on taxation and charity. So we considered all of these strategies. In these strategies, then, let's go back for a second, Michelle. So intermediate installment sale trusts, non-grantor trust, opportunity zones, Nevada onshore trust or an asset protection trust that's in Nevada or in the United States. Maybe a gifting trust for the kids that was taxed, that was still taxed in California, but was asset protected. How about their existing life insurance, transferring it out of their estate and then using it as the beginning funding bill for a bigger one, new life insurance? Spousal lifetime access trust, because we're trying to capture the coupons at its side before it goes down to $6 million a piece at 2026. They considered a monetized installment sale before they got to us, which they ended up not doing because of the risks in monetized installment sales, but did an intermediate installment sale, which is the top one. They might monetize it in 2 years after the 2-year related party rules happen. A non-grantor trust that doesn't pay taxes in California. They talked about grantor clats or not. They also talked about donor advised funds, charitable remainder unit trusts, a T-clat, a testamentary charitable lead annuity trust. The gift of the residence to the children with a lease back, considering Prop 19 in California. And then the gift of company stock to children's trust or not. So these are things we thought about and talked to them about. Probably 10 more. Please.
Were these things that they came to the table with, the advisor came to the table with, or we came to the table with?
They came to us with a burning hole in their pocket, wanting to spend money on a monetized installment sale because somebody said this is the one thing you need to do for it all. Upon understanding the associated risks, and like we always say, can we explain what's good about that? May we explain what's in your left-hand blind spot that are negatives about it you may not have heard? And can we explain what's on your right-hand blind spot, other strategies that might accomplish those goals with less risk? The client said, tell me about that. Which is fairly common in our world, right, Shelley?
Yep, very common.
So next. So as you can see, this is over at 4 different dates for each family, the Martin and Infam families, on 4 different design books. I will say 90% of our clients say yes on their first or maybe their second iteration of a design book. 10% of our clients, a few more. This client had beaten it. The most we'd ever done is 4. This client had 12 each.
I was gonna say, they didn't stop at 4, I don't think, yeah?
But you can start to see how the amount of money dedicated to each strategy in timing, combining, and sequencing changed over time and got more similar to each one at the end, more similar to each one at the end. Next, please. And this is no more or no less than, we'll show you the 4 designs from a graphic point of view from what we listed. The second one. The third.
So
Set
we can all take those in just a couple seconds, right?
Yeah. Because it's not meant to show all the words on it. It's meant to show that the designs are changing. There's a way to show the client from a schematic way how it works.
Yeah.
You're also starting to notice they're starting to pull strategies from each other and say, he's got that. How about me? How about this? So they're coming together as they're going. First, they wanted radically different plans, and they started to get closer because they started to talk to each other, spouses, et cetera. And you're still seeing how the numbers work out each time, What's the net benefit to them? So then when we get to the exact design book, we're going to show you one of them, in this case, the Martin design book. By no means is it our goal to have you see every page and read through each one, but to see how do you present to a client you can save and help them through the sale and adjust to estate taxes and asset protection as well. So the next slide, Shell. Again, goals and objectives fairly direct. Next. Their family information next. It gives you their statement of net worth like you saw before. Next, Shelley. And next, notes just what we thought the sale price would be. Next, if you could. And then after that, how their net worth would change. Post-sale, but before planning. So we showed what their life insurance was, but wasn't enough. They needed to change. This is their estate tax diagram on the estate taxes that would be paid, including on the insurance that was in their estate. Next. So we had observations, just like you would. Here are some tax problems. Here's some asset protection problems. Here are some other issues with the life insurance you have. Next page. So then we go over an overview of strategies, just like you would. We talked about an IIST. We talked about a name. We talked about what we would accept back as new co-stock. We ended up talking about a qualified opportunity zone after the sale, and a Nevada onshore trust to offer asset protection, not like the name that offers asset protection with an avoidance of California tax, but one that was just asset protection. Next, please. Of course, we talked about the insurance that I'd change it, and we talked about strategies that we considered beyond that they still might do, This particular client is actually presenting to their Tiger 21 group, and in presenting to Tiger 21 group, they're going through and they're explaining what we thought about doing in their design book and an as-is plan a year later. Next, please. So you can see there's some complexity, but it's offering to solve for all the issues that they talked about. The client at the end of the day said, oh, wow, if I'm going to go from my net proceeds of 40 million to 47 million, I'm in. Can you save me $7 million in taxes? Can you save me $7 million in taxes? We could actually save more, but they were under the pigs get fat, hogs get slaughtered, and they wanted more access. At the end of the day, we ended up saving more in income tax for that. This is the estate tax savings, If you can see in each one, would your family like to have the before or the after planning? Of course, they like the after, and the immense amount that goes to charity and cutting the IRS out. So it's a compelling story, both on income tax planning and estate tax planning. Next, please. So then there's a picture of each strategy. Go back a couple of slides, Shell. And one more. For each one of these boxes, we're going to show, here's the box of what it is. Here's the description. Then there'll be a page of language and sometimes a page of numbers to show how each one works, all the details that they can bring to their other advisors or be able to do. Picture this like a set of construction drawings that are engineering calcs and everything they can take to any builder and install, or they can use you. Next.
So this is one big picture. Now we're going to break down each box, right?
So Shelley, yes, ma'am. Shelley's just going to cruise through these, and you're going to see as she just continue to click, Shelley less than about a second a piece. Each one is going to have a picture that describes what it is, key benefits of design concepts and the math of how each one works for all those different boxes that we talked about. What this gives the client then and their advisors is a way to see how it works with detail and how the integration provides income tax savings, capital gains tax savings, future income tax savings, and asset protection, like I said, all in an integrated plan that can be implemented. So it shows them on the revised net worth, next page, please, that they're worth less because, next page, you've either reallocated or you've got some discounting. Next page. That's their plan again on what they decided to do. Their as-is plan was just a tad bit different. It talked about death in 2 different years. Next, please. So again, would they like to save $7 million of tax or not? Now, this client elected to pay, back one, Shelley, elected to pay some income taxes on the sale because they wanted the money freed up for personal use. They were also, their partner paid far less than this in income taxes. Their partner went down and saved, instead of saving $7 million in income taxes, their partner saved $14 million in income taxes, only paid $5 million.
Wow.
But it was a different type of plan, and it's whatever's appropriate for the client. Next, please. So it gives them next steps. Very important to a client when you present advanced planning strategies, asking them what is next or letting them know what's next for the collaborative team to get done. So this was a bit more of a technical presentation, gave you a lot more information on timing, combining, and sequencing of legal, financial, and tax strategies. Go ahead, Shell, I'm sorry. So remember, whether you're working your own process or you're working in collaboration with someone else, at what point is there a fork on the road when you use your process or you use theirs combined? Theirs combined. The next presentation we'll give will be on value acceleration. Well, Shelley will be doing most of it for Founders Group, and I'll be in for some color too. And then afterwards, family business conflict. Shelley, thanks for letting me talk so darn much.
Absolutely.